Welcome back to Bull Mindset. Have you ever wondered why so many traders start their journey with excitement, hope, and confidence, yet only a small percentage ever become consistently profitable? Most people believe the answer is strategy. Some believe the answer is intelligence. Others believe the answer is money, technology, or luck. But what if I told you that the biggest reason traders fail has very little to do with charts, indicators, or trading systems? In today's video, we are going to uncover the real reasons why most traders never become profitable. You will learn the hidden psychological traps that keep traders stuck for years. More importantly, you will learn how to avoid those traps yourself. Stay with me until the end, because this lesson may completely change the way you view trading success. And if you enjoy trading psychology content that focuses on discipline, emotional control, and long-term success, consider subscribing to Bull Mindset. Let us begin. When people first discover trading, they often see the rewards. They see traders posting profits. They see luxury lifestyles. They see winning trades. They see freedom. Very few people see the years of struggle behind those results. Very few people see the losses, the mistakes, the emotional battles, the discipline required. This creates the first problem. Most people enter trading with unrealistic expectations. They expect quick success. They expect rapid account growth. They expect the learning process to be short. And when reality does not match those expectations, frustration begins. The truth is that trading is one of the few professions where you can do everything right and still lose money on a particular trade. Think about that. Imagine a doctor performing a successful operation. The result is usually positive. Imagine an engineer following a proper design process. The result is usually predictable. But in trading, uncertainty always exists. A perfectly executed trade can still lose. This reality creates psychological pressure that many traders are not prepared for. And that pressure exposes weaknesses. The first major reason most traders never become profitable is impatience. Most traders want results immediately. They want profits this week. They want account growth this month. They want financial freedom this year. There is nothing wrong with ambition. The problem begins when ambition turns into impatience. Impatient traders force trades. They enter too early. They ignore their plans. They chase opportunities that do not exist. Instead of waiting for high-quality setups, they create action because they feel uncomfortable doing nothing. Professional traders understand something important. Patience is not inactivity. Patience is a skill. Patience is the ability to wait while others rush. Patience is the ability to remain disciplined when emotions demand action, and this skill separates many profitable traders from unprofitable ones. Now let us discuss another reason: the need to be right. This is one of the most destructive habits in trading. Many traders become emotionally attached to their opinions. They want the market to prove them correct. They identify with their analysis. When a trade moves against them, they feel personally attacked. Instead of accepting the loss, they argue with the market. They move stop losses. They increase position sizes. They hold losing trades longer than planned. The market does not care about opinions. The market does not reward ego. The market rewards discipline. The moment traders stop trying to be right and start focusing on managing risk, their results often improve dramatically. Now let us discuss another major reason: fear. Fear exists in every trader. The question is not whether fear exists. The question is whether fear controls behavior. Fear causes traders to hesitate. Fear causes traders to exit winning trades too early. Fear causes traders to avoid opportunities. Fear causes inconsistency. Many traders spend years searching for better strategies when the real problem is fear. They think they need a new indicator, a new system, a new mentor, a new course. But often they need better emotional control. Because the strategy is not failing. The trader is failing to execute the strategy consistently. Now let us discuss greed. Greed is simply the desire for more. And in trading, greed can become extremely expensive. A trader doubles position size after a winning streak. A trader ignores risk management because confidence becomes excessive. A trader refuses to take profits because they want even more. Eventually, the market reminds them that risk still exists. The problem with greed is that it often feels good in the moment. It feels exciting. It feels powerful. It feels rewarding. But long-term success rarely comes from excitement. Long-term success usually comes from discipline. Now let us discuss another important reason. Most traders focus on outcomes instead of process. This is one of the biggest mistakes in the industry. A trader takes a bad trade and makes money. They feel successful. A trader follows the plan perfectly and loses. They feel unsuccessful. This thinking creates confusion. Professional traders understand that outcomes can be misleading. One trade means very little. What matters is the process. Did you follow your plan? Did you manage risk properly? Did you execute consistently? Those questions matter more than the outcome of any single trade. Now let us discuss the problem of unrealistic expectations. Many traders believe profitability should arrive quickly. They compare themselves to social media success stories. They compare themselves to traders with years of experience. They compare themselves to unrealistic examples. Comparison creates frustration. Frustration creates emotional decision-making. And emotional decision-making creates losses. The reality is that becoming consistently profitable often takes years. Not weeks, not months, years. The traders who accept this reality are usually more patient, and patience improves survival. Now let us discuss another major reason traders fail. They do not treat trading like a business. Think about any successful business. A business has systems, processes, risk controls, performance reviews, long-term planning. Many traders do the opposite. They wake up, open charts, take random trades, hope for profits, and repeat the cycle. That is not a business. That is gambling. Professional traders understand that consistency requires structure. Without structure, emotional decisions take over. Without structure, long-term growth becomes difficult. Now let us discuss something that many people do not want to hear. Most traders spend too much time studying charts and not enough time studying themselves. They analyze market patterns for hours. They search for perfect entries. They search for perfect indicators. Meanwhile, the real problem remains untouched. Impatience, fear, overconfidence, lack of discipline, poor emotional control. The market often reflects personal weaknesses. This is why trading becomes such a powerful personal development journey. Because the market acts like a mirror. It reveals habits, beliefs, behaviors, and emotional patterns. If this lesson is helping you see trading differently, consider subscribing to Bull Mindset. Because understanding the psychology behind trading success is often more valuable than learning another strategy. Now let us move into some real trading examples. Because understanding concepts is helpful, but seeing how they appear in real situations makes these lessons much more powerful. Imagine a trader who has experienced 3 losing trades in a row. The losses were small. The risk management plan worked perfectly. Nothing unusual happened. Yet emotionally, the trader feels pressure. The trader begins thinking, I need to recover. I need a winning trade. I need to get my money back. And suddenly the focus changes. The focus is no longer execution. The focus becomes recovery. This is where many trading careers begin moving in the wrong direction. Let us continue with that trader. 3 losing trades have already occurred. The account is still healthy. The losses were controlled. The strategy is still valid. But emotionally, the trader feels uncomfortable. Instead of waiting for the next quality setup, the trader begins searching desperately for an opportunity. Every chart suddenly looks attractive. Every market movement appears significant. The trader takes a trade that does not meet the original rules. The trade loses. Now the emotional pressure increases. Another poor decision follows. And before long, a manageable drawdown becomes a serious problem. What happened? The strategy did not fail. The market did not fail. The trader abandoned discipline. This example represents one of the most common patterns among struggling traders. The inability to remain patient during difficult periods. Now let us examine another example. Imagine a trader experiencing a strong winning streak. 5 profitable trades. 6 profitable trades. 7 profitable trades. Confidence grows. At first, this feels positive. But then something changes. Risk increases. Position size increases. Rules become flexible. The trader begins believing that success is guaranteed. The market quickly provides a reminder. One large loss erases several previous gains. The trader becomes frustrated. Why? Because confidence became overconfidence. And overconfidence is often just as dangerous as fear. The profitable trader respects risk during winning periods. The struggling trader often forgets about risk during winning periods. Now imagine another trader. This trader has spent years searching for the perfect strategy. One month, they use price action. The next month, they use indicators. Then they switch again, and again, and again. Every losing streak triggers another strategy change. Eventually, years pass. Little progress occurs. The trader concludes that profitability is impossible. But the real issue was never strategy quality. The real issue was inconsistency. No strategy was given enough time to demonstrate its potential. This is another reason many traders never become profitable. They constantly search for something new instead of mastering something useful. Now let us discuss some mental frameworks that can dramatically improve trading performance. The first framework is called the business owner mindset. Imagine you own a successful business. Would you judge the business based on one day of results? Probably not. Would you shut down the business because of one difficult week? Probably not. Businesses are evaluated over months and years. Trading should be viewed the same way. Many traders become emotionally attached to daily outcomes. Professional traders focus on long-term performance. This shift reduces emotional pressure, and reduced emotional pressure improves decision-making. The second framework is called process over outcome. Every day, ask yourself, did I follow my plan? Did I respect risk? Did I execute properly? If the answer is yes, the day was successful, even if money was lost. This idea may seem strange at first, but it is one of the most important lessons in trading. You control your process. You do not control market outcomes. The more attention you place on controllable factors, the more consistent your behavior becomes. Now let us discuss another framework, the probability mindset. Many traders expect certainty. They want every trade to work. They want every analysis to be correct. But markets operate through probabilities. Even excellent setups lose. Even professional traders experience losing streaks. Accepting uncertainty creates emotional stability. Resisting uncertainty creates frustration. The goal is not predicting every outcome. The goal is managing probabilities effectively. Now let us move into practical exercises. The first exercise is called the weekly reality check. At the end of every week, review your trades. Do not focus primarily on profits and losses. Instead ask, did I follow my rules? Did I remain disciplined? Did emotions influence decisions? Did I take unnecessary trades? This review creates awareness, and awareness creates improvement. The second exercise is called the emotional journal. After every trade, write down how you felt. Were you confident, fearful, impatient, greedy, frustrated? Many traders record only technical information, but emotional information is often more valuable because emotions drive behavior, and behavior drives results. Over time, emotional patterns become visible. Once visible, they become easier to manage. The third exercise is called the 5-minute pause. After every loss, step away from the screen for 5 minutes. Do not immediately search for another trade. Do not immediately attempt recovery. Pause. Breathe. Reset. This simple habit can prevent countless emotional mistakes. The fourth exercise is called the long-term perspective exercise. Every time a trade loses, ask yourself, will this trade matter in 1 year? Most of the time the answer is no. This question reduces emotional intensity. And lower emotional intensity leads to better decisions. Now let us discuss a truth that many traders eventually discover. Profitability is not primarily a technical challenge. It is a behavioral challenge. Most traders know what they should do. The difficulty is doing it consistently. They know they should follow rules. They know they should manage risk. They know they should avoid overtrading. The challenge is execution. This is why psychology matters so much, because psychology influences execution, and execution influences results. Now let us discuss another important lesson. The traders who become successful are not necessarily smarter. They are not necessarily more talented. They are not necessarily more experienced. Often, they simply remain committed longer. They remain disciplined longer. They continue learning longer. They continue improving longer. Persistence creates opportunities for growth. Many traders quit before those opportunities appear. That is why patience is so valuable. Now let us discuss identity. Many struggling traders identify as victims of the market. Profitable traders identify as students of the market. Victims blame, students learn. Victims search for excuses, students search for lessons. This difference may appear small, but over time it creates dramatically different outcomes. Now let us move toward the final takeaway. Why do 95% of traders never become profitable? It is not because they lack intelligence. It is not because they lack opportunity. It is not because profitable trading is impossible. Most traders fail because they lose the psychological battle. They become impatient. They become emotional. They become inconsistent. They focus on outcomes instead of process. They search for shortcuts instead of mastery. They want quick results instead of long-term growth. The market rewards different qualities: patience, discipline, consistency, humility, risk management, emotional control. These qualities may not sound exciting, but they are powerful, and they are often what separates profitable traders from struggling traders. Remember this: the goal is not becoming perfect. The goal is becoming slightly better every week. A little more disciplined, a little more patient, a little more consistent. Those small improvements compound over time, just like investments compound. The traders who survive long enough to improve usually give themselves a chance to succeed. The traders who constantly restart the journey often remain trapped. So if you feel frustrated today, remember this: you do not need to become perfect overnight. You simply need to keep improving. One lesson at a time, one trade at a time, 1 week at a time. If you found value in this lesson, subscribe to Bull Mindset. Our mission is simple: to help traders master their mindset, strengthen their discipline, and build the psychological foundation required for long-term success. Thank you for watching. Keep learning, keep growing, keep developing your bull mindset, and I will see you in the next video.